live, and welcome to another Life After Hours with Life Sherpa, that time of an evening when we shine some light into the dark recesses of financial advice and personal finance generally. Tonight, of course, we're focusing on EOFY, or the end of financial year, which is coming up in about 6 weeks. But before I get started and give people a bit of a chance to scoff down the last mouthful of dinner, grab a glass of wine and pull up the sofa and relax, I would just like to acknowledge the Camaragal people, the earliest recorded occupants of the lands that today we call North Sydney. So welcome, welcome, welcome. Of course, end of financial year is an important time for many people. It may not be quite as exciting as New Year's Eve, but it is a time to reset, reflect and renew. So tonight we're going to go through a little bit about what's special about this end of financial year. There are a few things happening. Probably they're not the most exciting budget in the world, but definitely some things to consider. And then we'll look at year-end prep generally. And of course, as always, these evenings are about you. They're not about me. So get your questions in the chat, and we'll get to those as we go. The value in these events is largely getting your questions answered. And so I'm only going to talk for probably about 20-25 minutes and set the scene, but it is all about you. So get your questions in the chat. So to get started, I really want to just put end of year in context. Now, as those of you who've been on these events before, you'll know that we like to put things in the context of our Life Sherpa 8-step framework to financial freedom. And this is covered in some detail in the book, and we'll put a link in the chat later for you to get a discount of the Live the Life You Want with the Money You Have book. And I can even sign it for if you'd like. So the 8 steps, we have 3 foundation steps, which is spend less than you earn, build an emergency stash and pay off your debts. And this is really the foundation on which you build all of the rest of your financial goals. Then there's 3 protective steps, and these are the things that keep your plan on track. In some ways, it's the plan you have for when the plan you need for when the plan you have doesn't go according to plan. And that is step 4, prepare for the unexpected, which is largely around insurance and protecting yourself from the unexpected. There's step 5, sort your super, which is about preparing for retirement and getting all those steps in place so that you can let compound interest do the heavy lifting. And of course, step 6 is get your paperwork sorted. So that's about all of the things you need to do to make sure that your financial and personal life keeps going when you're not around, whether that's because you're incapacitated or because you died. And so lots of important paperwork that you need to get done. And then, of course, the exciting stuff, step 7 and 8, which is the buy and pay off your home, and step 8, invest your surplus. And put those 8 together and you have a framework for achieving financial independence or financial freedom. So end of year prep sort of fits in step 1 because it is about balancing your budget. It's about making sure that you pay no more tax than you need to. And it's about making sure that you get all of the deductions that you're entitled to and all the offsets and refunds you're entitled to. And of course, step 6, which is about paperwork, so getting your tax return done. Obviously, to do that, you need some information and you need some forethought. a little bit of a fun fact. People talk about a tax return. The tax return is actually the form that you lodge with the tax office. The money the tax office gives you back is a refund, not the return. So the return is the document, and that comes from the Old English concept of returning your income to the king. So you had to demonstrate what you earned, so you returned your income. Today that's just a form, but people often think about the refund they get as the return. But the return's the form, the refund's what you get to spend. So having put that context in place, now let's move on and think about this end of financial year in particular. And the big news for anyone who's been hiding under a rock is that tax rates are falling in the new year. At the lower end, no change to the tax-free threshold. It's still $18,200. The lowest rate of tax falls from 19% to 16%, and that's up to $45,000 of income. From 45 to 120, there's no change. That's still 32.5. Oh, sorry, that 32.5 drops to 30. Sorry, and the 37% rate for those earning between 120 and 135 drops to 30%, and no change from 135 to 180, and then from 180 to 190, 45 becomes 37. So a bit of a simplification, widen the bands. So the vast bulk of taxpayers will now fall into that 30% tax rate. So anyone between 45,000 and 135,000 will pay a marginal rate of 30%. And that's coincidentally the same as the corporate rate. So the benefit of this simplification is there's a lot less incentive for most people to use trusts and other avoidance structuring techniques. So it could very well result in more taxes being collected. It is intended to be largely revenue neutral over the forward estimates. I think the explanatory memorandum tabled in Parliament suggests that they might raise $1 billion or so more over the forward estimates, which is the next 4 years of government income. So largely, and then remember that is compared to the originally scheduled stage 3 tax cuts. This is still a reduction compared to the 2024 tax year. So everybody will get a tax cut. As long as you earn more than $18,200, you will get more in your pocket in 2024-5 than you did in 2023-24. And this little graph shows you what that might be. So at the top end, it's worth about $4,500, and for a significant chunk of the population, it's worth just under $3,000. So for most people, you're going to see more money in your paycheck every fortnight, every week, or every month. And that's a great opportunity to do something with that money before you become used to it, whether that's aiming at paying off debt or achieving a goal or investing. So, look at your first paycheck in the next tax year and work out how much more you're getting in your pocket, and then decide what to do with that. So a little bit of mindful review after you get your first paycheck, and make sure that doesn't fall through the cracks. Sure, many people have struggled a bit this year with increasing cost of living, but great opportunity. It's money you've never had before, so time to do something sensible with it. So the next material change is some of the super superannuation contribution limits. So the one that affects most people is the concessional limit. This year, that's $27,500 a year, and that's rising to $30,000 for next year. And so most people are able to make a concessional contribution and claim a tax return. If you're under 18 or over 67, you need to pass a RIC test. But for the vast bulk of the population, you can claim a tax deduction. And so for somebody on the 30% tax rate, a dollar of income put into super will result in 85 cents turning up in your super fund. That's the dollar less the 15% contributions tax in your super fund, and you get to claim a 30-cent deduction, meaning it's only cost you 70 cents. So there is no argument that superannuation is the most tax effective way of saving, and over your lifetime will lead to a better result than most other forms of investment. The downside, of course, is that there's restrictions on what you can do with it, and you don't get to spend it till you turn 60. So you need to think about whether the tax benefit is worth the inflexibility trade-off. And if you haven't yet bought your home, or you still have significant debts, then that might not be the most practical use. And certainly your Sherpa can help you make that trade-off. The other change is, just to be clear, concessional contributions are ones that somebody, whether you or your employer, claims a tax deduction for. So your compulsory super contributions are concessional, your salary sacrifice contributions are concessional, and your personal contributions for which you claim a tax deduction are concessional. And generally, if you've got taxable income and you've got capacity, they're the ones you should normally be making. The other type of contribution is called a non-concessional contribution, and that's where nobody claims a tax deduction and the fund doesn't pay tax on it when it receives it. And the limit for non-concessional contributions is 4 times the concessional limit. So as the concessional limit goes up from 27,500 to 30,000, the concessional limit therefore consequently goes from 110 to $120,000. Now that's not available to everybody. So if your super balance exceeds $1.9 million, you can no longer make concessional contributions. And if your balance is less than that, you can usually bring forward 1 or 2 years of those. So a great opportunity if you get a lump sum of money you inherit from great Aunt Murgatroyd. Generally get your concessions done. The good news, I guess, or the bad news, if you've had a pay rise, is that the Division 293, that is the extra tax on contributions, that threshold hasn't changed. So if you earn more than $250,000, including your super contributions, then your super fund pays an extra 15%. So that's effectively 30% tax on those contributions. So obviously, if you are earning $250,000, your personal tax rate is 47%. So it's still a tax benefit. But I guess the thing that's pressing for this June 30 is that where you haven't used your concessional limit from previous years, you can use up to the last 5 years of those to make contributions. And at the end of this year, the unused stuff from the 2018-19 tax year disappear in a puff of smoke at midnight on June 30. So if you've got some unused 2018-19 limit, you have probably 2 to 3 weeks to get that into your super fund. Again, if you want to talk about that, ask your Sherpa. Of course, we've just talked about the limit going up to 30. It's only been $27,500 for 3 tax years, so the 21-22, the 22-23, and the 23-24 years. And that's, I think, a bit of a sign of the little blip in inflation we've had over the last few years. Prior to that, it was $25,000, and it had been $25,000 for some time. So that's concessional contributions. So when it comes to dealing with your personal tax return, the first step is, well, what did I earn for the year? And income covers a wide range of things. So obviously your salaries and wages, and your employer will lodge that with the tax office. So that will generally be pre-filled. What you used to get a payment summary in paper, which you had to get by the 14th of July, will now automatically turn up in your MyGov account. Similarly, traditional investment income like bank interest, dividends, managed funds, and ETF income, they're all generally, as far as the income is concerned, they're generally reported quite well by the banks and fund managers. So you'll generally find they are relatively accurately pre-filled. Where you get managed funds or ETF distributions, it is always a good idea to double check back to your AMIT statement, which you'll get from the fund manager. Some of this stuff won't be available for some time. So if you're trying to get your tax return done early, you may find that some of this information is not available. It's getting faster. Historically, if you had investments in property trusts, or REITs as they're called now, real estate investment trusts, they're often late because working out how much of the distribution was tax deferred is a relatively complex question. So you may need to wait some time from that. If you got made redundant during the year or got paid out annual leave or long service leave, you may have a lump sum or termination payment. And again, that should be pre-filled, but always worth double checking the calculation. If you work for a tech company or some other company that's got a share scheme, you may have had shares that vest this year. You should get an ESS statement from your employer, and it's certainly worth following that up. You may have a rental property. That's probably where it starts getting a little bit complicated. The income side's clear, but when we come to the deductions, that's a little tricky. And don't forget that rental property includes the rent you charge or flatmate. And if you put your apartment on Airbnb while you went away for holidays, that's income too, and the tax office will know. Foreign income, just because it arose out overseas, doesn't mean the tax office doesn't know about it, so don't forget that. Cryptocurrency, anyone who's had a crypto account probably got a letter from the tax office in the last month or so saying, we know you have a crypto account and you didn't return this on your 2023 tax return, please explain. So be careful there. That's fairly complicated for many coins. Certainly if you go beyond the traditional Bitcoin or Ethereum, it can get complicated. Definitely worth checking out Coinly or some of these other accounting systems if you're doing that seriously. And of course, capital gains. Now, these ones are not pre-filled in your super fund, and if you've sold some shares, you'll need to work out your capital gain. And that's not as straightforward as it might seem, particularly if you've been dollar cost averaging and putting in regular amounts to buy small parcels, or you tick the dividend reimbursement plan box, you may end up with lots of small parcels of shares with different cost bases. And if you've rebalanced and sold a small part of your holding, you may need to do a bit of work to work out what your gain was. And that's where a tool like ShareSite can come in very handy to tell you what your capital gain actually was and to give you some advance heads up of what your capital gain would be if you made this transaction. For those of you here with a paid Life Sherpa membership, you get a free ShareSite account. Go to Basecamp and check that out. So that's all of the income stuff. Most of this stuff is pre-filled. So most fund managers, investment houses, banks, exchanges report to the tax office. So we may have a self-assessment system, so nobody is checking the numbers when you submit them, but they will get checked and you may need to support them at some time. So you need to make sure that you've got a supportable, reasonably arguable position when you lodge your tax return. And of course, if there's anything that's slightly out of the ordinary, consult your accountant. Now, the deductions are, I guess, where the magic happens. And the big ones for most people are obviously work-related deductions, home office expenses. And I'll come back and just talk in a little bit more detail about working from home, because that's obviously becoming fairly well the norm. So work-related deductions, your briefs, your professional memberships, your ongoing training, tools, all those sort of things. Home office expenses, self-education, professional development, registrations, subscriptions, protective clothing, laundry, and tools and equipment. Now, with the tools and equipment, you obviously need to distinguish between stuff that's depreciable and stuff that's claimable. Laptops, for example, can be salary packaged very tax effectively. Vehicle and travel expenses, lots of options there, and make sure that you've got good records. The other ones that a lot of people miss out on is your accountant or tax agent fees. So when you pay your accountant or tax agent to do your tax return, that fee is deductible. Now, usually you'll be paying it in the year following the return. So you may be able to pay that in advance. Certainly my self-managed super fund accountant, when I had it, used to always give you the opportunity to pay for it in June, help their cash flow, and of course helped your tax return. Personal super expenses, we talk about that. So concessional contributions, make sure you lodge your notice of intent with your super fund and then include it in your tax return. One thing about personal contributions, so that's contributions that are not employer contributions or salary sacrifice, but ones where you write a check or BPay, more likely these days, the money into your super fund. You need to lodge a notice of intent to claim that tells the super fund that this is a concessional contribution. If you don't tell them, they will assume it's a non-concessional contribution. And you need to give them the notice of intent before any money moves out of your super fund. So if you're paying for your insurance premiums out of your super fund, or you're rolling your super fund over to a new fund, make sure that you've lodged the notice of intent before you do either of those transactions, because that, if the money moves out of your account, you will no longer be able to lodge a notice of intent. The money has to be in the fund where it was contributed in order to, at the point of making the notice of intent. And I see people pay, insurance premiums is the big one. So you may find that the media would suggest that you leave it as late as possible to lodge it so that the money is working in your account. Because when you lodge the notification, the super fund will take the 15% contribution tax. So that's great cash flow planning, but it can be a disaster if you're moving money out of your super fund or paying your insurance premium. So great care. Be careful with that. So investment income, investment expenses, that might include subscriptions to the Financial Review, your share site subscription, your Morningstar subscription, some research that you buy, and it can also include interest on margin loans and some financial advice fees. We had been lobbying, both as Life Sherpa and as an industry, to get clarity around deductibility of advice fees. That historically, fees from managing existing portfolio were tax deductible, but the fee to set up a new plan wasn't. The fee for budgeting wasn't. We thought we might have got some traction there, but the tax office issued some new guidance to, in effect, reaffirm the old guidance. So it really needs to be very closely related to managing an ongoing portfolio. The upfront advice fee could very well form part of your cost base for CGT purposes, but talk to your accountant about that. The other big change on advice and portfolio management fees is that the advice fee will no longer attract a GST input tax credit, which saved about 25% of your, 2.5% of your fee. That's been, as of July 1, that will no longer be available. And then, of course, income protection insurance. All of you, of course, have income protection insurance, the most important insurance for most people, because if you depend on your income to pay your bills or achieve your goals, you really need to think about what would happen if your income stops due to accident or illness. So, what goals will you abandon? What assets will you sell? What bills won't you pay? It's not particularly expensive. A fully comprehensive insurance package for most people will be in the range of 2 to 5% of your income. So, and of course, income protection is tax deductible, and the other ones can generally be paid for from your super fund. So definitely check that out. There is a QR code on the screen. So if you've got a big screen, you might be able to scan that. That will take you to a page on the ATO website where they have gone out and for most occupations, they've made a fairly comprehensive list of what they think appropriate deductions might be for that occupation. Well worth checking out before you lodge your return. You may be a bit late for this year if you don't have receipts, but definitely worth considering. I think we'll put the link in the chat as well, but scan the QR code or copy the link from the chat. So at year end, the general rule is, which I'll come back to in a moment, but this year it's particularly important. So if you earn between 18,200 and 135,000, your marginal tax rate is going to fall. So a tax deduction is worth more this year than it is next year. And similarly, if you earn between 180 and 190,000, your marginal tax rate will fall. So a deduction is worth less this year than it is next year. So it makes more sense to, assuming you have the money, to get that deduction into the 23-24 tax year rather than waiting for the next tax year. So we'll look at what they might be. So that reinforces the general rule that you want to bring forward expenses. So you want to get as much of your expenses into this year as possible and defer as much income into next year. And for those whose tax rate's falling, that's even more important this year. So what do I mean by that? Well, clearly, superannuation contributions. So they're worth more this year as long as you've got the income. So bringing those forward to this year from next year might be a good idea. For those of you working on the First Home Super Saver scheme, be careful about not going over your 15,000 of extra contributions for any one year. Prepay expenses, the big ones here are interest. So if you've got a margin loan with leveraged equities, for example, they have an option to prepay your interest for 13 months. You may be able to prepay your insurance or subscriptions. Renew your professional membership now rather than in July. Many operate on a financial year basis, but if you actually pay it this year, you'll be able to get the deduction in this year. Vehicles, rego, inspections, repairs, maintenance, new tyres, all of those, fill up your tank on June 30. All of those little things can make a difference. So my rego is due on July 13th, which is the day I took delivery of the car, but I always make sure that I pay those. I get my inspection done, I do my rego, I do my annual service and get all that out of the way in June so that I can put that straight into my tax return. And of course, defer income is the other big one. So if you're looking at selling some shares, or maybe you're rebalancing your portfolio and you think, oh, I'll do that year end, that's a really good time to do it, you might actually be better off waiting till July 1 to do those trades so that that gain falls into next year's tax return. If you're selling your home, maybe don't sign the contract until July 1. Oh, sorry, not your home, investment property. So all of those little things can all add up and add up to a significant saving, especially this year where the value of those deductions will go down in the new year and the cost of the tax on the income will go down. Capital gains are a very interesting thing. So if you do have a capital gain, it's always worth looking to see, do you have a capital loss lying around in your portfolio somewhere? And so if you have a gain, look and see if there's something that you can sell. But it's important to know the relevant dates. So if you're selling a property, the event happens on the date of the contract, not the date of settlement. So it's the date that the contract is signed. That's the date that the CGT event happens. So if you sign the contract today and settle in July, when you get the money, you actually owe the CGT in this year. So a bit of a trap for young players. If you sell shares, it's the date of the contract note. And obviously with T+2, there's a much shorter gap between the contract note date and the cash date. But again, if you're rebalancing your portfolio, maybe wait till July 1. Now, be careful here about what are called wash sales. So if you have a loss that you intend to sell, don't buy the same shares back within a short period of time. That can result in the ATO denying you the loss, which obviously defeats the whole purpose of the sale. So don't sell VAS and buy A200 if you're trying to realise a loss. Depending on when you bought your ASX 200 fund or ASX 300 fund, you may very well be sitting on a short-term loss. So it could be a good idea to harvest that loss and reset your cost base and avoid paying some gains on your existing funds. Many people will be sitting on crypto losses. So that's capital gains. Now, the other big one, working from home has now become such a part of what we do as a workforce, or a society, and this again creates an opportunity for a tax benefit. The good old days of the big COVID incentives are gone, so they're no longer available. But there's still some opportunity to get a reasonably significant, particularly if you work 3 days from home. This can really add up. Again, QR code in the corner. link in the chat. So the basic rules are you can take the easy way out and claim a fixed rate method of 67 cents an hour. Now 67 cents doesn't sound an awful lot, but there are 1,800 working hours in a year, so it does add up. Or you can claim the actual costs. For most people, the 67 cents option will be almost as good and way less work. Unless you have significant expenses, maybe you have a home study. But if you're working on your laptop on the dining room table, the 67 cents is generally going to be a better answer. The 67 cents is designed to cover the incremental costs of working out: electricity and gas, phone and internet, stationery, and computer consumables. For most people, they will be relatively small. The days when you chew through paper and printer ink are now largely behind us. Most of us operate even in financial services like Life Sherpa, we are very much a paperless business. And so consumables are less of a big deal. But certainly phone and internet, stationery, so your daily planner, pen, your notebook, all those sort of, your briefcase, all those sort of things. But in the context of home office, it's largely easier just to claim the 67 cents. You can also separately claim, so you can claim the 67 cents and then separately claim depreciation on equipment that you use, such as your computer, bookshelves, chairs, desks, whatever else that you might have for your work. You obviously got to prorate this between personal use and work use, but this can certainly add up. If in doubt, get your accountant to work that for you. For some people, it may also be possible to claim what are called occupancy costs. This is mortgage interest, rent, water, council and water rates, land tax, insurance. But bear in mind that there are CGT implications for doing it. And they're generally not available to employees. So unless you are employed from home where your employer does not provide an office. So if you have a desk in the city but happen to work at home 3 days a week, this is not for you. If you're employed remotely as maybe a sales rep in a remote territory and you must work at home and you do have a dedicated space that's not used for anything, or you're a chiropractor and you've got a or a masseuse where you've got a separate room set aside for that work, then this could be for you. But bear in mind that the CGT implications for, particularly if it's your home, can come back and bite you at the end of the day. Talk to your accountant. Now, when you're working from home, there are things you can claim. So no coffee, tea, milk, and bickies, even if your employer did provide them for you in the office, not tax deductible. You can claim stuff that relates to your kids' education. So if you buy an extra iPad that your kids use for school or to watch Bluey, not deductible. Anything your employer gives you or reimburses you for, not deductible. So that's why the 67 cents is often the easiest, quickest route.